How's it going today, guys? So today I'm going to be answering a very simple question that a lot of people have, and that is, how do banks make money? How do banks actually make money if all they're doing is lending out money to people and letting you store your money there? Well, today we're going to be answering that question. And really, it is a very simple concept, but there are a couple of different entities involved with this process. That is the US government, if we're talking about the United States, and then we have the central bank, and then we have the commercial banks. And the commercial banks are the banks where you are depositing your money and borrowing money from. So first of all, the central government sets a target as far as where they expect inflation to be over the next year, and based on that, the central bank sets the federal funds rate, or the interest rate they are going to charge to the commercial banks. Now, if inflation is expected to be higher, they're going to increase that federal fund rate, and if inflation is expected to be lower, they're going to decrease that federal fund rate. Now, the commercial bank is going to borrow money from the central bank, but they're actually going to charge a markup on that interest rate. So just for an example here, let's say the inflation target is set at 2% by the government, and as a result, the central bank decides they're going to charge a federal fund rate of 1%, but the commercial bank is going to charge 5% interest instead. So it's up to the commercial banks as far as what they're going to charge customers in terms of an interest rate. If the central bank decides to lower the interest rate, the commercial bank may decide to lower their rate as well and pass that savings along to the consumer, or they might keep their rates where they are. But they're making money on the markup here between what they're borrowing the money for and then what they're loaning it for. But that's not the only way they're making money. They're also making money in a different way. And when you look at this, a lot of people are going to get pissed off. Honestly, it's crazy that banks offer you next to nothing in interest, but when you turn around and borrow money from them, they do not hesitate to rake you over the coals with some astronomical interest rate. But basically, when it comes to a commercial bank, you can lend money to the bank by putting money in a bank account, or you can borrow money from the bank by having them loan you money. So if you lend money to a bank by having a savings account or a checking account or a CD or maybe a money market, different things like that, they're going to give you a very small amount of interest for borrowing or holding on to your money. Now what they're going to do, they're going to hold on to that money, but they're going to be lending it out to other people. That is why if everyone went to the bank tomorrow and tried to pull out their money, they wouldn't be liquid and they wouldn't be able to pay out all of that money because they're expecting that most people are not going to be drawing all of their money out at once. And as a result, they are loaning that money out to other people and earning a rate of interest on it. So if you put your money in the bank in a checking or savings account, you'll make about 0.05% per year. And maybe if you open a CD, it's slightly better. A one-year CD might pay you around 0.5% interest. Now where things get interesting is if you go ahead and turn around and then borrow money from that bank. If you're borrowing money for a credit card, it's probably going to be 15% or more interest. If this is a personal loan, it might be 10%, and a mortgage is lower because this is a secured loan, and if you don't pay your mortgage, they're going to foreclose your house and they're going to sell it at an auction, so that's why it's a bit lower. But the way a bank makes money is very simple. If you lend money to a bank, if you lend $1,000 to your bank for 1 year in a CD, they're going to pay you $5 in interest. But if you were to borrow that same $1,000 from a bank in the form of a credit card, then they're going to charge you $150. So they'll pay you $5 if you let them borrow it, but if you borrow that same amount of money, they're going to charge you $150. That right there is how banks make money. It's very simple, and that's why banks are profitable, and that's why you can invest in bank stocks, and they're not just convenience items available to us. They're making money on the markup of the interest rate. But anyways, guys, I thought this would be an interesting video topic. If you enjoyed it, please drop a like. If you're new to my channel, please consider subscribing to be notified of any future uploads. And as always, I thank you for taking the time to watch this video. If you are interested in learning more about investing in the stock market, I've created a free course just for you. The link is in the description below. Here are a few other videos you might enjoy as well.